All right, hey, hello everybody. This is Colin Quina with 3T Futures. Just continuing on with updating our little monthly, educational session here on our platform. So I wanted to put together a little video here, guys, on vertical call spreads. Those of you who are involved with DTI know we've been doing a lot of things. They've been doing a lot of things with vertical call spreads. First thing we're going to do is we're just going to bring up a chain for educational purposes. I'm not calling any kind of trades right now, so we'll just take a look at the ins and outs of the vertical call spreads, and go from there. Make sure, like I said, make sure we're all on the same page. We all know how they work and what the idea is behind them. So we go ahead and bring up my option chain for the S&P. Guys, if you don't have your option chain active here, this the active icon to bring it up here directly from your quotes page. If you don't have that active or don't have that part of your quotes window, come over here to the far right hand side where you see this drop down arrow, left click, add and remove buttons, go to standard, and then you see all the different icons that are available to be added to your quotes window. The Find Option Chain is down here below, and the icon looks like a chain link that you would find. So anyhow, so as soon as I've got that icon up and available, I'm going to click and highlight the quote that I want to bring up here, which is the S&P, and we'll go ahead and bring up the option chain. Went to another screen of mine, so I'm going to bring it in here, and you can see here we've got the option chain. Make this a little bit bigger, and let's increase our number of strikes so we can see a little bit more about this market here. Increased it too many. But anyhow, so here we have our option chain. We've got both calls and the puts. We're just going to concentrate on the call side for now. So I'm going to drop down the type and just go with the calls. And you can see here it gives me all my calls, both in the money and out of the money in the S&P. Notice the expiration is actually today. So, in interest of making it somewhat like a real trade, we would never do this today with the expiration coming up in just a few hours here. So let's move it back. Let's move it back just to the regular December expiration, December 19th. Just we'll get a little bit more prices, a little better prices. So anyhow, so first things first, when we're looking to do a vertical call spread, we want to figure out which legs we're going to do. Okay. We're going to figure out which legs we're going to do, and depending on the kind of spread we're doing, depends on whether we're going to go out of the money or we're going to go in the money. For right now, we'll just keep it simple. We'll just keep the same legs. We'll just do the same legs to describe both a debit spread and a credit spread. So so we won't have to worry. We won't worry about in the money versus out of the money at this point. We'll just stay out of the money right now for where the prices tend to be cheaper at this point. Next thing, okay, I'm losing this, so I need to make this stay on top. There we go, so it won't disappear anymore. So anyway, so let's figure out our two legs. So what I'm going to do is I'm just going to bring up my two legs. Let's just go ahead and bring up the 2080s. All right, so I'm just going to left click here, right clicking on this, and I'm just going to bring up a dome of that line. Let the dome come up, went to another screen, so I'm just going to bring it over here to this screen. And then we're going to go and we'll just do the 2095s as well. Okay, so I'm going to left click 2095s, do another right click here to bring up the dome. Let's see. There it goes. Bring up my dome. And it went again over to another screen, so let's bring this back over. Okay, good. So here we do. Here we have our two legs that we're going to use, the 2080s and the 2090s, the 2095s. Now, this is where we figure out, we got our two legs. This is where we figure out, well, is this going to be a credit or is this going to be a debit? Okay, and determining that is all hinges on what do you do with the more expensive leg. You can see right here, the 2080s, since we're closer to the market, since it's closer to the actual market, is going to be more expensive. This is the more expensive leg. So depending on what we do with this expensive leg, if we buy this leg, and sell the the less expensive leg, the 2095s, if we buy the expensive leg, sell the less expensive leg, well, we're going to be debited, right? So we're buying more than we're going to be debited more than we're going to be credited. Okay, so that would be a debit spread, right? So let's take a look. I'm just going to go ahead. I'm just buying the market here, and I'm going to sell the market here. Just real quick like that. Okay, so you can see I'm long here from 16.5, which means that this leg right here was worth 16. The price was 16.50, but when I do my calculations to figure out what it's worth, timesing that by 50, because that is the underlying point value of the S&P, you can see that this cost me $825. Okay. Then when you come over here to the other side, this one's easy because we got right at 10. You can see I was credited $500, right? So the difference between what we were debited, $825, and then what we were credited, $500, is what you were debited fully, okay? So do your subtraction, $825 minus $500, you get $325. So this spread right here that we did was 6.5 points, because we can figure out the spread price by subtracting the option price, 16.50 by 10. We can see 6.50, so you can figure out what we bought it for 6.50 is our spread price. Times 50 equals $325, which is, of course, how much it cost us, 6.5 points, or, like I said, the difference between $825 and $500. So again, there's your credit spread. All right, that's your credit spread. We know we got this at a $6. We got this at $6.50. So we want this to go higher. Obviously, we want the spread price to go higher, and how that happens is the market is going to go higher. We'll want to go higher in this situation. Okay, for a credit spread, we want the market to go up, or we want the spread to widen. Okay, we want the spread to widen. We want these prices to diverge and not converge. Okay, so we want, like I said, we got it at 6.5. We want our legs, like I said, we want the spread to widen. Okay, we want it to go from 650 up, to 10 or higher, what have you, to make profits on the spread. So that is the case here, and that will happen. These markets will diverge. These two legs will diverge, mean they will grow further apart, which widens the spread as the market goes up. Hence, that is what we want our strategy to do when we place a credit spread. Now, you have a couple options. Okay, you have a couple options. Determining, exiting this market, okay? To take the full profits, to take the full advantage of the spread, we would have the market would need to come up above our higher strike price. It would have to come above 20.95 to realize full profit. If it comes above 20.95, that means both of our legs are in the money. Our long leg is in the money, our short leg is in the money. If we get exercised on that, we will be issued a long position from 2080 and a short futures position from 2095, or we will be profitable 15 points. So that's if the market, if you expect a big move, you're going to take this to expiration. If you expect a big move to the upside on a credit spread, you're going to take it to expiration to get the full profits. In this case, the full profits would be 15 points minus the $325 that I paid for. So in this case, it would be 15 times 50 equals, we'd be credited, we would get, with that 15-point futures trade that was exercised to us, we would get $750 from that trade. So it cost us $325. So 750 minus 325, we'd be profitable $425 on that trade with just one lot. Okay, with just the one lot. So that is the credit spread. Now, let's reverse this now. Okay, so I'm going to go ahead and I'm just going to exit the market here, cancel, exit market and cancel. So I'm going to get out of this. So let's now reverse this. Okay, so now we just went over a credit spread and the reasoning behind placing a credit spread. Now let's do the opposite. Let's go through and see what a debit spread looks like. Again, it all hinges on what we do with this more expensive leg. Okay, the more expensive leg here again is the 2080s. So if like I said, we just bought it then, so now I'm going to sell it. So now I'm going to be credited $825, and then I'll be debited close to $500 if I get the same prices, that is. So let's go here. I'm selling the more expensive leg. I got it at 16, which is a little off the chart here. You see here, I got it at 16. All right, so I'm going to come over here, and I'm buying this side now, and I got it at 10 quarter. Okay, so now my spread is I went 16. I sold 16, which is $800. All right, so that's worth $800, and I bought it for 10 quarter. Okay, so 10 quarter again, like I said, pretty close to what we just did at 10. It's gonna be 512.50 there is what that one cost me. So again, like I said, we were credited by selling the 16. We were credited $800, and we were debited $512.50. So again, do our math. And when it comes to $287.50, that's how much we were credited. That's what makes it a credit spread. Okay, we were credited the $287.50 because we sold the more expensive leg, bought the cheaper leg, and that was the difference between the two. Again, you see here our spread price at $575. Yeah, spread price there, $575, which equals what we were credited in this case. And in this case, just like so it's basically the opposite for the credit spread. We wanted the market to go up, and we wanted the spread to widen or diverge. Well, in this case, we want the market to go down, and we want these numbers, we want these prices to converge or get closer together and really narrow that gap. We want to narrow the gap between the 10 quarter and the 16.75. We want these, or the 16. We want 10 quarter and 16. We want that gap to come together or converge and get and really tighten up or narrow the spread. We want the spread to narrow. We want it to go from 612 or from 575. We want it to go down, preferably down to 0. In that case, you'd be fully in the money, and you again on the bottom side you would have the full payout if gone into the money there. So, but anyway, that kind of explains it. So again, just remember, guys, remember what you do with the more expensive leg determines what you want your market to do. Okay, what you do with this more expensive leg, whether you buy it or sell it, hinges on whether it's a credit or a debit spread. And again, credit spreads, we want this market to go up. Debit, or we want the market to go up, and we want the spread to widen. With a debit spread, we want the got that backwards. With a credit spread, we want the market to go down. We want the spread to tighten or to narrow. And with a debit spread, we want the market to go up, and we want the spread to widen or diverge, get further apart. Okay, so go through that one more time. It all is going to hinge upon what we're doing with our more expensive leg. If we sell the more expensive leg, it's going to be it all hinges on what we do with this more expensive leg. If we buy the more expensive leg, it's going to be a debit spread. If we sell the more expensive leg, it's going to be a credit spread. Okay? For a credit spread, we want to see the market go down, and we want to see the spread narrow or converge together. For a debit spread, we want to see the market go up, and we want to see the spread widen or diverge to make the spread price more expensive. All right. Debit spreads, we want the spread to be more. We're buying it. Debit spread, we're buying the spread, so we want it to be more expensive on exiting. For a credit spread, we are selling it, so we want it to be cheaper or more narrow of a spread upon exiting the trade. So that'll conclude our this month's continuing education on the platform on credit and debit spreads, or vertical call spreads as they're referred to. So that'll do it. We'll look forward to get another one of these done next month, and hope everybody enjoys.